Forex oscillators show firm market turning points and may send out untimely or false signals on moving markets. Other indicators monitor the state of investors' mass psyche. Okay. Now, so you have to get in mind that you have three different segments. Oscillators are very, very unique. Okay. And most new traders, or some experienced traders, don't realize the differences. And when you're building your trading system, you have to include each one of these types. Not because what happens is today, things like MACD and RSI are very, very popular in the marketplace. They get lots of press coverage, and they become buzzwords for people. And basically, they are the same oscillator. They both will tell you the market's overbought and oversold. So if you're saying, I use MACD and I use RSI, well, you're duplicating your efforts, but you're leaving a whole bunch of the market out. And so therefore, you have to use segments of each of these. But oscillators are quite unique, and most people don't understand exactly what oscillators do and how they do it. So oscillators usually change before actual price change, and thus may help to identify a turning point. So when you have price trending up or trending down, an oscillator will tell you that the market is becoming oversaturated. Not that an overbought market or an oversold market can continue for quite some time or might go into a consolidation point at this time. It doesn't tell you to buy or sell. Okay, your technical indicators and your trend indicators tell you to buy and sell. So the most commonly used oscillators are stochastics, rate of change, smooth rate of change, momentum, relative strength index, elder ray, force index, and commodities trading channel index, amongst some others. Okay, like I said, the most popular out there are RSI and stochastics. But the momentum indicator is a great tool also. Now, Forex oscillators show us the moment when the Forex market, or any market, reaches its limit in any direction, and the opposite correction of the trend becomes extremely probable. Not that it's going to happen. It's becoming more and more probable, and as that indicator moves farther in a direction, the market gets heavier. When a price goes up too high, analysts say that the market is overbought. This simply means that the price will stay stable or even slide down for some time because traders are willing to fix their profits. And during negative corrections, new traders will be entering the market, rising up the price. Respectively, oversold markets mean the opposite condition, when the price fell too much and the positive correction is likely to happen. Likely. As a general rule, it's better to buy on oversold markets and sell when the market is overbought. But again, these are not signals to enter the market. These are indicators that something is likely to happen. As the value of the oscillator approaches the upper extreme, the asset is deemed to be overbought. So it's just reaching that extreme. Okay. So it's not telling you when it's going to tip. It's telling you it's getting too heavy and going to tip, but it can't predict when that tip will happen. And as it approaches the lower stream, it is indicated as oversold. There is another element in oscillator analysis, which is also very important. Oscillators are used not only to discover overbought and oversold conditions, but to foresee breaking point in price movement. Some of them are mathematical transformations of price. And on graphs, their lines usually move in the same direction with price. When the line starts to move apart, an analyst considers that the trend is losing its momentum. Oscillators are especially useful for that. So let's go over real quickly before we go back to all this text, and let's take a look at, I've got some charts up on the screen, And let's just take a look at the two of the most popular indicators, just so you see what the lines are that we're talking about and what we're discussing when we're talking about these. So let me pop them up on your window. Okay, so we're looking at a gold trading chart. As we were looking at a 4-hour chart, but it doesn't make a difference. We'll click down to a 30-minute chart. Now, we see price up above in the candlestick, but it doesn't matter to us, or it doesn't matter to me, which type of chart you're using, because these have nothing to do with the style of charting you're using, and they also adjust to the time frame, because the indicators, or in this case the oscillators, are mathematical calculations that use price, and they adjust to the time segment you're using. So if you're using a 15-minute time segment or you're using a 1-hour time segment, when you put them on the charts and change them, they're going to change right along with them. Now, I've already put RSI on the chart and stochastics. The formulas for tonight are unimportant, because if you want to become an expert in RSI, you've got to learn everything from how to do the calculation to RSI to all the fine variables, which can take quite some time. Now, these indicators or oscillators are called bounded indicators, because when they are calculated, they will always come out between 0 and 100, because the formula always comes out between these numbers. Now, so therefore they are bounded in between the 0 and the 100 range. Now, there are standard formulas, or each one has a formula, but when they come out, they are, hold on one second. Okay, when they come out, they will come out 0 to 100. Now, as you notice on this chart, RSI, the standard interpretation for RSI, is anything over the 70 line is considered overbought, and anything below the 30 line is considered oversold. Otherwise, it is mute in between. And that's why you see this and I've just colored these. You can do whatever you want with them. But you see this unimportant zone in the back in the yellow, because they're not telling you anything when they're in the back in the yellow. But when they break above or below these crucial lines, which is the 30 line and the 100 line, the 70 line, they're then telling you the market has gotten overbought or oversold. But as you see here, we climbed up all the way up here, okay, and it was a way high figure indicating the market is way overbought. And we can see the market started to ease down, but it doesn't mean it reversed its trend. It eased down a little bit, but it turned around later and just continued farther up. But at this point, it was indicating the market was overbought. Now, stochastics, which is also a bounded indicator, or therefore an oscillator, consists of two lines. Now, these two lines and their calculations also come within the 0 to 100 range, and anything above 80 in stochastics, is considered overbought, and anything below 20. But again, what these ranges are not important for tonight. If you want to use one of these, you have to learn all about that indicator. What we're showing you is they still come out, but the ranges are slightly different, but they still indicate overbought and oversold. Where stochastics also uses two lines, a K and a D line, and when these lines cross, they also give you an indication of a buy or a sell. So when they cross over and they're above, it is a lot more important than just the number. So again, you have to learn their interpretation. But as you notice, they are bounded, and I keep reinforcing this, between the 0 and the 100. And when they come up to this white zone above this dark black line, they are then indicating the market is overbought or oversold or about to shift, but they don't guarantee any result. See here, we had a huge crossover and we're way over at 87, but the market still didn't come down. The market continued to trend upwards. So it's only telling you what could be happening. Okay. So, but this is how you put them on charts. They fall, and because all these indicators are very popular, you just come up here to indicators, you find the calculations in the mathematics are already built in, and we simply scroll down to where we find it. And it doesn't matter what charting system you use, they're going to offer you the indicators, and most of the oscillators are very, very popular. So we just scroll down alphabetically until we came down to RSI or MACD, or we could just go back up to momentum indicator and click on that and add that onto our, and momentum indicator is also another oscillator. And again, we can see that's now put on the third on the bottom of the screen, and it goes between 0 and the momentum indicator uses a 0 and a -10 range above and a -10 range below to tell you something about the markets. Because this is giving you the momentum or the strength or the speed of the markets. And this is an oscillator also. And it's bounded, but it's not bounded between 0 and 100. It's bounded between -10 and 0. Okay. So these are the different types. So let's go back to my PowerPoint and let's talk a little bit more about what they do for you. So hold on, let me pop it up here. Okay. Now some analysis of Forex oscillators consists of two basic elements. First, discovering if the market is in a short-term overbought or oversold condition. And second, determination of the dispersion with the price as a value of the oscillator approaches its extremes. Momentum and rate change, ROC, are the most basic oscillators. A price graph tells us if the price is going up or down. The oscillator graph then tells us about the pace or the speed of that momentum. This type of indicator helps us to assess whether a current trend is gaining strength or losing strength. So we looked at the momentum indicator on the third one I put on the charts. You saw it was based on a 0 line and a -10 and up above and a -10 below. And what it's telling you is whether the market is gaining momentum. Is it moving up and getting stronger as it's moving up, or is it coming down and getting stronger as it's moving down, or getting weaker as it's moving down? Because that tells you it tells you the conviction of the buyers or the sellers. Okay. These types of indicators help us assess whether the current trend is gaining strength or losing it. On later stages of an uprising trend rate of price increase slows down. This loss of momentum may not be seen on the price graph, but is fairly visible on the supporting oscillator graph. Indicators assessing momentum and rate of change are fundamentally essential. So again, let's go back to the chart real quickly. So these three indicators don't work exactly the same, and one is gauging the strength of the market, and the momentum indicator will tell you when the momentum is burning out, even though the price, the graph up here, continues to move on and upward. It's telling you the buyers are getting exhausted. So when we peaked right here, we could see what happened here. Again, it's not telling you the market's going to reverse. What happened at this peak here? The market went into a whole area of consolidation because it was telling you that these buyers had lost their momentum. and the markets then move forward in a consolidation area while the bears and the bulls fought it out, and the bulls eventually won back and regathered their momentum again to move upwards. Now, this won't, because if you notice, this doesn't work in conjunction with stochastics at this point and RSI, because they were both below their overbought or oversold indicators. Because it's not saying the market's overbought or oversold, it's just telling you that the buyers are losing their momentum. As you notice, price still was able to move upward. Oscillators are the most beneficial when Forex, I'm sorry, I just got to get my marker won't turn off here. Oscillators are the most beneficial when the Forex charts are not showing a definite trend in either direction. In trending markets, oscillator signals should be taken with maximum caution, provide that false signals generally stand for strengthening of the trend. So the next rule of oscillator analysis is that the upward trend oscillators show overbought conditions and vice versa on a downward trend. Major graph software programs offer a great variety of oscillators in order to assist a trader in defining extreme market conditions. So we've already put on 3 on our chart. The most valuable are momentum, which we put on the chart, and rate of change. The next most popular are the probably relative strength index and stochastics. So we've looked at them. The only thing we haven't put on the chart is ROC. These types of indicators this type of indicator is eminently useful during fractional markets movements or when a trend reaches its final phase. All oscillators lose their validity in the middle of a strong trend. It's better to use other indicators such as moving averages on trending markets. There are also some indicators combining advantages of moving average trends following an oscillator's oversold and overbought condition. But even when the market is trending up, the oscillators will give you a forewarning. They're not saying do anything. They're saying, hey, trader, I'm telling you, the asset's now moved pretty much to the top of its range. Because you're not sure how far a range can be. It's telling you based on all the mathematical calculations that the market is getting ready to ease. Now, again, because these are used by buyers and sellers all around the world, the market might react to the indicator and just go into consolidation while people are deciding what to do. Now, oscillators warn you of the end of a trend. An oscillator is an object or data that moves back and forth between the 2 points. In other words, it's an item that is going to always fall somewhere between point A and point B. Okay. In most cases, there's 0 to 100, except in momentum, it's -10 to +10, -10 to -10 over top of the 0. Think of our technical analysis our technical indicators as being either on and off. More specifically, an oscillator will usually signal buy or sell, with the only exception being instances when the oscillator is not clearly at either end of the buy or sell range. Does this sound familiar? It should. Stochastics, parabolic SAR, and relative strength index are all oscillated. Each of these indicators is designed to signal a possible, and again, I'm going to go over it, a possible reversal where the previous trend has run its course. Each of these indicators is designed to signal a possible, and I'll keep reiterating, possible reversal. Okay. Now, a change of momentum is often a signal that the current trend is weakening. For this reason, traders need tools that can measure market momentum. When it comes to trading, one thing is certain: all prices will eventually reverse. The closer to the reversal point you can get you can get to into an appropriate position, the greater your profit opportunity. Keep in mind, however, the earlier you act, the greater the chance that what you believe is a reversal is in fact only a fluctuation, and you could find yourself on the wrong side of a trend. A momentum oscillator can help you distinguish between reversals and fluctuations. So you should use something like ROC or momentum as well as RSI and stochastics. Together, they give you a much better set of information. But you should not use them without using other tools like support and resistance, trend lines. No individual tool is enough to tell you anything. Each one is giving you a clue. Each one's giving you an indication. Now, perhaps the most widely used oscillator in Forex, the MACD, needs no special introduction. What it does need is a proper explanation on how to use it. MACD is one of the most unique indicators that you can use and one of the best. The idea of MACD is to signal your entry points when you're already figured out where the trend is going. It's not going to give you an alert to the trend. Okay, now, MACD stands for moving average, convergence, and divergence, and it's two lines that will calculate between a range, but when they do crossovers, they give you very specific pieces of information. MACD is one of the few oscillators that actually gives you buy and sell signals. So we can come back over here to our charts, and let's drop back MACD on there. Okay, so let me pop the charts back up here. Okay, now we're going to add MACD. Okay, now I'm not telling any of you to use any of these. I'm giving you examples of different classes of these. So we're going to scroll down here to MACD. Again, it's MACD, and it stands for Moving Average, Convergence, and Divergence. And we can see it down here on the bottom, and the MACD gives you two lines that are calculated, and the MACD indicator is used with a crossover. Okay. When the lines converge or diverge, they are telling you something. So they actually tell you to enter or exit the market at this convergence point. So but it's important to be able to interpret it, whether the orange line or the blue line, which stand for different things, crossover, or whether they're diverging when they cross over or converging. In other words, here we see the orange line going over top of the blue line, and here we see the blue line moving over top of the orange. So we have a convergence, and here we have a divergence. They're both crossovers, but they both tell you something different. Again, each one of these indicators you have to learn to master. It's not something that somebody's give you 3 sets of instant rules and you're going to trade by them. But this is how you would use oscillators in your trading scenario. And understanding what they mean and finding out what class they fit into is very, very important, so you're not wasting your time. Because then there's all other types of indicators, like Bollinger Bands, that they're trend indicators, okay? And you see that they actually operate completely different. And we put Bollinger Bands, they actually fall on the chart and go directly on your charts, okay? And these are bands that go around. They're not indicators or oscillators, okay? Then we have things like moving averages. They go right on your price charts, and they are a relationship between the price movement and the bands or the lines on the chart, which is completely different than your interpretation. So your trading strategy has to pull areas of each one of these types of tools so that you're not just duplicating. If you just tried to use RSI and stochastics, you'd be wasting your time. Okay. You need to find all the areas, so you need to learn about the different types of indicators and the different classes of indicators, and which ones fall as oscillators, which are bounded oscillators, which are non-bound. We also have leading and lagging indicators, ones that support and tell you that something is really good, and ones that help predict moving forward. So you have things like Ganfans and Fibonacci numbers that go on to your charts. So we can go here and we can, where's my Ganfans? Hold on a second. Okay. And we can put Fibonacci's, but the Fibonacci levels actually go right on our charts and tell us something. Okay. So again, they're all different classes of indicators and oscillators. And you have to learn what they are and what the differences are. So let's go back and learn a little bit more precisely about these oscillators. So let's go back to my PowerPoint again. Uh-oh. There we go. So again, stochastics is one of the most interesting indicators of the oscillator family. What I like about this indicator is that it essentially gives you two-dimensional picture of overbought and oversold and momentum. Unlike MACD, that's not always accurate on overbought and oversold. The idea of stochastics is twofold. First, it normalizes from 0 to 100. Anything below 20 is oversold and anything above 80 is overbought. Second, using a convergence between the percent K and the percent D line, those were the orange and the red lines, the orange and the blue lines we looked at, tells you something. Not only can you tell when there is an overbought and oversold level, but also when the trend turns bullish or bearish. Thus, it affords a two-dimensional use of momentum. Confused? Okay. Well, here's a classic example of how I would use stochastics. In the first part, we can see that in point C, after the pair has, and I'm sorry, I didn't make this chart easy enough for you to see. I put it in the background. But here we see down here, we see this is our RSI calculations. Here we have our K line and our D line. And this is C right here. And so we can see that in point C, after the pair had bottomed out, though a double bottom trend was indicated, which we see here on our charts, okay, we can use the oversold level as enforcement, but wait before dipping our toe into the buy position. So here we saw a chart. We had a double bottom. We had the crossover here at C indicating that the market was oversold. And again, we're using other interpretation, but then what happened to the marketplace? However, one thing is important to note is that at point E, which is all the way out here, in point E we get a blue line crossing the red line as it does with C. Since the crossover occurs very close to the overbought and oversold, that should deter us from establishing it as an entry point. So let me get my markings up here so you can see a little better. I'm sorry, I shouldn't have put this in the background. So what we see here in E, see, when we had C, it was below our indicator line. So it was down in the overbought range. When we have the indicator here at E, it is not. Okay, so it's not giving us, even though we have the crossover, it's not giving us a strong enough indication, although it was a false signal because look what happened in the marketplace. Okay. But this is what we're looking for. We're looking for it in the oversold and getting the crossover, or in the overbought and getting the crossover. So it's a combination of understanding and reading it together. Stochastics is a simple momentum oscillator developed by George Lane in the 1950s. So it's been around, what, 50, 65, 67 years. Being a momentum oscillator, stochastics can help determine when a currency pair is overbought and oversold. Since the oscillator is over 50 years old, it has stood the test of time, which is a large reason why many traders use it today. Though there are multiple variations of stochastics, and there are, Now we have slow stochastics, we have fast stochastics, we have RSI stochastics, because these are all new. They don't change the original stochastics. These are new buzzwords, things that there are strategies that some other trader developed using the mathematical calculation of stochastics and pushed it out in the market enough that it got enough press for a while that it becomes part of the available things. Okay, now I don't use slow stochastics at all. I only use stochastics. I don't use stochastics much anyway. Okay. Slow stochastic is found at the bottom of your chart and is made up of two moving averages. These moving averages are bound between 0 and 100. Traders are constantly looking for ways to catch new trends that are developing. Now, momentum, okay, is a great way to look at how to enter and exit the market. Momentum shifts direction when the two stochastics lines cross. So this is a lot of reason a lot of traders like to use this. Again, I use my MACD. I am a firm supporter of MACD. It's one of my favorite indicators. Okay. Lots of people like using the crossovers from stochastics. Okay. As you can see from this picture, the short-term trends were detected by stochastics. However, traders are always looking for ways to improve signals so they can be strengthened. There are two ways we can filter these trades to improve our signals. Now, all of this starts to sound complicated, but today, because we have all of this computer-generated stuff, and these are basically just formulas, let's go over to our charts again. We keep bouncing over there. I'm going to take most of the stuff off the charts. Okay, let me just close this out because I want to show you how we do this. And I'm using the free charts. Well, I pay for my charts, but we're using the free charts from TradingView. You can go to www.tradingview.com and get the charts. There's no cost for them. Okay. Now, I've taken everything off of here, all the indicators and everything. So we're going to go up here under Indicators again, and we're going to scroll down to Stochastics. And you see, here's stochastics. Here's stochastics RSI. You know, that's a combination of using them together that somebody came up with. But we're just going to put the stochastics on our chart. Okay. You see it in the purple background is the dead man zone, and then you have the white between the 80 and the 100, and the white between the 0 and the 20. You have the K and the D lines in blue and in red. Okay. All of that gets complicated. But now, today, because of computers, life has gotten really easy, and these new advanced charts. We're going to go right down here to stochastics again. And we're going to go over here to stochastics slow strategy. We're going to click on there. Now, let me get my... Okay. And what is done is it's already programmed in. And as you can see on our charts, it's actually putting the points of these on the charts, okay, and telling you exactly what levels they are, tying it back here to this level. And if you want to use them as your trading signals, they've also built in the whole strategy down here, and you could say using this, how profitable that strategy would have been on gold. And then you can adjust the strategy to make it exactly your own, and it'll put the numbers right on your charts. So you get the arrow down here, you got a sell signal here, you got a buy signal here, you got a sell signal, and it's already pre-programmed in, and you can test it all you want. You can change it, modify it slightly, and it just makes it easy. You don't have to sit here and keep interpreting them and trying to line them up with your charts. Okay, so it's an easy way to use your stochastics. Let's go back over here again. So basically, on the chart you're looking at, when it catches up to here, okay, these have been put on by hand. Okay, you don't have to put them on by hand anymore. All of the reds and the green arrows and circles and everything else are now just automatically put on your charts for you. Okay. Now, naturally, a trader won't want to take every signal that appears. Some signals are stronger than others. The first filter we can apply to the stochastic is taking the crossovers that occur at extreme levels. Since the oscillator is bound between the 0 and 100, overbought is considered above the 80 level. On the other hand, oversold is considered below the 20. So as you can see, by simply taking those ranges, we filtered most of those signals off of this chart and come down to just a little handful of signals that were very accurate and very precise. Now, the second filter we can look at is trend filters. If we find a very strong uptrend, the stochastic oscillator is likely to remain in overbought levels for an extended period of time, giving many false signals. We would not want to sell a strong uptrend since more pips are available in the direction of the trend. So in other words, if you were in the market, you don't want to sell and get out of that market at the false signal, or you don't want to sell into the market at a false signal because you can still move enough that you get stopped out and you can't afford to stay in the markets anymore. Then we have another one, which is called average true range. Last but not least of my favorite indicator is the average true range, ATR. Unlike the other two oscillators, the ATR is useful in anticipating potential rises and falls in volatility. So now we can put in our momentum, our volatility, and our overbought and oversold situations. Now we're actually using the oscillators to build a trading scenario. So also, unlike the other two, there is no overbought and oversold levels. If the ATR is high, it suggests volatility in the market is high. Conversely, if the ATR is low, it suggests volatility is low. How can we use this to predict volatility? We know, of course, that volatility is cylindrical. If we decide to use support at an entry signal, we can use ATR to gauge whether there's a chance to buy. For our buy trade, we'll have strong momentum. And ATR is a great indicator. It will tell you when the volatility in the market is about to spike or relax. And when you get that strong volatility and you're at a support line, it's going to tell you that volatility is going to push you above that support line. So you can use that with the ATR, and you can see where it's judging the range down below, and then you can see the reaction on the charts as volatility is increasing, and then coming up here to the maximum. It increased here, pushed it up to a high, and then as it started moving back down, we got more volatility. And it's just as simple of telling you how volatile the markets are. Then we have awesome oscillator day trading strategies. These are combining these together into strategies to change. So with names floating around as complex and diverse as moving average, convergence, and divergence, as Stochastics, I guess Bill is attempting to separate himself from the foray. Bill Williams is the one who came up with the awesome oscillator. Okay, and we can combine this awesome oscillator. It's gaining in much more popularity, and it uses the combination of several oscillators to come up with a firm mathematical decision. While on the surface, one could think the awesome oscillator is comprised of a complex algorithm developed by a whiz kid from MIT. You may be surprised to learn the indicator is a basic calculation of two moving averages. That's right, folks. Not an EMA or a displaced moving average, yes, but simple moving averages. Okay. To my earlier point, if you have a basic understanding of math, you can sort out the awesome oscillator equation. The formula compares two moving averages, one short-term and one long-term. Comparing two different time periods is pretty common for a number of technical indicators. The one twist the awesome oscillator adds to the mix is that the moving averages are calculated using the midpoint of the candlestick instead of the close. And it will appear on your charts. And if you notice, what you see on your chart here is actually what you saw on our stochastic and our or MACD chart underneath of it, because it's also using the same indicators, same equations. Let me just pop it up here. Sorry about that. Just let me get my screen back here for you. So when we put on the indicator here of the MACD, because all of these calculations are not that same. So what you see underneath here on the MACD is actually a combination. See this graph underneath? It's a combination of using the mathematical equations. And Bill Williams sorted it all out into this little oscillator indicator, which came up and combined all this together. Now, the awesome indicator, when it's put on the bottom of the chart, gives you very precise signals, and it gives you very unique buy-in signals. If you use this strategy itself, you will lose money. I hate to speak in such absolutes, but to trust an indicator blindly without other confirming analysis is the quickest way to burn through your cash. Wow, did I just go off on with that without further explanation? Okay. Therefore, the strategy, if you call it that, calls for long positions when the awesome oscillator goes into the negative, from the negative to the positive territory. Conversely, when the awesome oscillator indicator goes from the positive to the negative territory, a trader should enter a short position. But again, you can't use this without using other indicators, but it's got a high reliability. So it works extremely well because it is a variation of the other indicators to give you some type of signal what's going on in the markets. Okay. Now there's also all other types of interpretations. Okay. You can pick, there's different meanings of different oscillators. Like I said, you have to learn each one of these oscillators. Stochastics has all of its variations. MACD has its crossovers and its divergences. You have to learn in which direction they're going. RSI, and there's this whole family of these that you need to master. But you can understand now how you separate them to build them into different categories or groups to when you're thinking about building a trading strategy or using them together on your charts, that you shouldn't just go click, 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 or use all the names that you've heard in the marketplace. No, you need to understand which group they're coming from, what they tell you, and how to decide which indicators have value to you at the moment and which you want to use in your trading strategy. So on that note, I'm going to say goodnight to you. Thank you very much for joining us, and I hope I pointed out some interesting things to you, gave you some things to think about, and put you on the right path to understanding oscillators. Thank you very much, and thank you for being part of the Investing.com family. Bye now.